the main reason that gold is being accumulated is because central banks have lost confidence in the dollar and in the fiscal responsibility of the U.S. government or the credibility of the Federal Reserve. So you're seeing it first in gold. I think you'll next see it in the dollar. And then I think you'll see it after that in the Treasury market, where you'll start to see a big drop in bond prices and a rise in long-term yields, despite the fact that the Fed is going to be reducing short-term rates. But I think gold is just indicating that a much bigger crisis is coming. Gold is the first shoe to drop. Gold soaring like this is telling you that the dollar is going to go down, that bonds are going to go down. If you wait for that, if you wait for the move in gold to also be reflected in a big down move in the dollar and a down move in the bond market, well, you're too late. You're too late to diffuse the crisis, but you're also too late to prepare for it financially.
Gold's relentless rise is not random market noise. It's a signal. It's the monetary alarm bell warning of a deeper sovereign and dollar crisis ahead. Central banks around the world are quietly exiting the dollar system, diversifying reserves into hard assets as confidence in U.S. fiscal discipline collapses. The surge in gold prices is the first shoe to drop, reflecting eroding faith in the Federal Reserve's credibility and the Treasury's sustainability. What follows next, according to Schiff, will be the dollar's decline and a sharp repricing of U.S. debt as global investors begin to sell treasuries and demand real returns. PeterSchiff, veteran economist and founder of Euro-Pacific Asset Management, believes this moment mirrors the subprime warning signs of 2007, ignored until it became a crisis. Gold is flashing the same message today. Those waiting for confirmation in the bond or currency markets will be too late. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, I'm more concerned about a U.S. dollar and sovereign debt crisis, because I think that's going to be the consequence of the Fed bailing out all these banks and preventing that. The Fed does these stress tests every year, and I always point out that the stress tests are all BS, because they don't stress test for stagflation. They don't have any scenario in which they test how a bank would perform with stagflation. So if we had a recession with rising inflation and rising interest rates, they don't test any banks for that. And I think that's because they know they would all fail. And so they don't even want to run a test if they already know that no one's going to pass. But that is the environment that we're in, and it's going to get a lot worse. And I think the only way that we're not going to see widespread failure in the banking system is if we have massive money printing. And so that's going to ultimately cause a dollar and sovereign debt crisis. And again, that is what gold is telling you. Gold is the monetary canary in the coal mine. Gold is shooting up now for a reason. To me, it's very much like the collapse of subprime in 2007, because I had been forecasting subprime to collapse for years before it did. But I forecast that as part of a broader banking crisis, financial crisis, that I knew would follow the collapse of the subprime market, which would ultimately take down the mortgage market and the banking system and Freddie and Fannie. And I've been talking about that and warning about that. I wrote about it. But when the subprime market blew up in 2007, the mainstream dismissed it as an isolated event. Even the Federal Reserve said, don't worry, it's contained. And I was out there saying, no, it's not. It's the tip of this huge iceberg. Just wait. And of course, we had the crisis the following year in 2008. Well, to me, I've been warning about a big move up in the price of gold as foreshadowing a dollar crisis and a sovereign debt crisis. And now it's happening. And just like the mainstream dismissed the warning from subprime, they're dismissing the warning from gold. But I think gold is just indicating that a much bigger crisis is coming. And I've even heard people say that we don't have to worry about the price of gold because the dollar's not falling, because the bond market isn't falling. And so therefore, gold's rise is not reflective of a loss of confidence in the dollar or the bond market. And my response to that is just wait. Gold is the first shoe to drop. Gold soaring like this is telling you that the dollar is going to go down, that bonds are going to go down. If you wait for that, if you wait for the move in gold to also be reflected in a big down move in the dollar and a down move in the bond market, well, you're too late. you're too late to diffuse the crisis, but you're also too late to prepare for it financially. That's why I keep, reiterating with my clients, look, you got to buy gold, you got to buy silver, hey, you got to dip now to 4,100 or, I think 4,000 is really the new 3,000 for gold. So 4,000 is kind of the support. Doesn't mean we can't go below it, but I think any dip below 4,000 will be short-lived. Silver got up to 54 and change, so it took out the 50 double top. We're back below 50 now. I mean, silver is a lot more volatile. You don't have the central bank buying to stabilize it like you do in gold. But look, I think silver has clearly broken out. It's proven that 50 isn't a ceiling anymore. Soon it's going to be the floor. People should be buying silver. I think it's very cheap, and people should be getting out of U.S. assets. I think the U.S. stock market, which has been really in a massive bear market for 25 years, I think that bear market's going to accelerate. But finally, after many, many years, foreign markets are smoking U.S. markets. I think the S&P is up maybe 13, 14% this year. I've got a foreign dividend payer fund that's up almost 50% this year. This isn't my gold fund. This is just my defensive dividend paying stock fund. But so foreign markets are finally way outperforming the U.S. And I think that trend is going to continue. It's not just central bankers who are getting out of dollars into gold. It's foreign investors who are going to be getting out of U.S. investments and reinvesting domestically. That's going to be followed by Americans diversifying internationally. Gold is rising as a reflection of a loss of confidence in the dollar, because I think the main reason that gold is being accumulated is because central banks have lost confidence in the dollar and in the fiscal responsibility of the U.S. government or the credibility of the Federal Reserve. So you're seeing it first in gold. I think you'll next see it in the dollar, and then I think you'll see it after that in the Treasury market, where you'll start to see a big drop in bond prices and a rise in long-term yields, despite the fact that the Fed is going to be reducing short-term rates. And I think that is going to be the catalyst for a return to quantitative easing, because I think the Fed is going to try to lower long-term interest rates through its open market operations, where it needs to print money to buy the bonds that the rest of the world is selling. And so that, I think, will be another catalyst to drive gold to even higher levels, because that's just massive inflation. And, the last couple of times we tried QE, inflation, at least the way the government purports to measure it, was below 2%. So the government was able to justify QE by saying, look, inflation is below target. And so we could do this because the goal is to get inflation higher to reach our target. And so, we're going to accomplish that with QE. But if inflation is already well above 2%, what is the excuse for creating more inflation? How do you justify QE when inflation is 4 or 5%?
Well, that's
the way
simple,
the government
Peter.
measures it. So, what does that do to the present value of gold if inflation is going to be 50% higher from now until the end of time? But of course, they're not going to achieve 3, because if they give up 2 and they move to 3, well, then they're going to give up 3. They've already proven that their target is BS when they're above it. They don't have the monetary cojones to do what it takes to bring inflation down to 2%. Well, then why would they have it to bring it down to 3% or 4%? So I think, once they move it, they're done, which is why they probably won't. I don't know that they're officially ever going to say that they have a target of 3. I think they're going to keep a target of 2, but they're just never going to hit it. And I thought it was really ridiculous in the last FOMC meeting. Somebody actually asked Powell about his forecast, because he pointed out, hey, 2 years ago, you predicted that in 2 years, inflation would be 2%. And now it's 2 years later and it's way above 2%. And you're still predicting that 2% will have 2% inflation in 2 years. And he said, why should we believe you? What makes you more confident now than you were 2 years ago when you made the same prediction? And Powell basically said, look, we don't really know where inflation is going to be in 2 years. It's just that 2% is our target. So that's our forecast. We just assume that we're going to hit our target, but we have no idea. So in other words, they just make it up. The only reason they forecast 2% is because they want it to be 2%, not because they think it's going to be 2% or they have any reason to believe that it's going to be 2%. So they could just keep on talking 2% inflation, just to pretend that they've got that target. But, we're not going to go anywhere near it. What they may do to try to get closer to 2% is not change the target, but change the CPI. I mean, that's how the government operates, right? You change the methodology for calculating the CPI so that you get a lower number. That's what they did with the Boston Commission. That's why the whole CPI is irrelevant today, because it's been rigged by the government to have a low number.
The global financial balance is shifting away from the US dollar as central banks accelerate gold accumulation, signaling a historic transformation in the monetary order. For decades, the world relied on the dollar's reserve status, a privilege that allowed the US to live far beyond its means. That era is rapidly ending. Nations like China are preparing for a gold-backed reserve model, using tangible wealth to secure stability in a world increasingly skeptical of American fiscal discipline. What makes this moment different from past gold rallies is the fundamental shift in motivation. It's not driven by speculative traders or short-term market enthusiasm. Retail participation remains low, institutions are still underweight, and the real accumulation is happening behind closed central bank doors. The dollar's credibility crisis is no longer theoretical. It's unfolding through trade settlements, currency diversification, and quiet de-dollarization. Gold's rise is not a trade, it's the next system forming in real time. Let's get back to the interview.
China is buying to have gold as a reserve to replace the dollar. And I think that's what a lot of other central banks are doing. They're buying gold to restore gold as, the monetary backing of their currency. And this, I think, is a major, transformation in the global monetary system. I think it's on the order of, or maybe bigger than what happened in the 1970s when we went off the gold standard. And so the world went from having the US dollar backed by gold as the reserve to just having a fiat currency as the reserve. That was a significant shift in the monetary order. But now it's not the US going off the gold standard, it's the world going off the dollar standard and returning to the gold standard. And I think that's probably even more significant, certainly for the United States, because we're about to have the rug pulled out from under us. And, we've been living off of the dollar's reserve status. We've used it as a crutch to live beyond our means. We've enjoyed lower consumer prices and lower interest rates and higher asset prices as a result of this privilege that I think we are in the process of losing. So when you point to these other moves up in gold and silver, I think they were largely driven at the peaks by speculators, by retail investors who were, jumping on the bandwagon and pushing the markets to, kind of extreme points, and then they would go down. I don't think we've even seen that yet. I think that retail investors have barely participated. In fact, if you look back at the flows from all of last year and most of this year, retail investors were selling gold ETFs. They were selling gold stock ETFs. So they sold into the rally. They weren't buying. In fact, if you talk to a lot of the smaller coin shops around the country, and I've seen interviews, most of the people that came in over the last few months were people that were selling their gold. They were like bringing in their jewelry to melt it down and get some cash. It wasn't a frenzy of people looking to buy gold. And the institutions, are barely involved. The pension funds, the endowments, hedge funds, they barely have any position in gold. It wasn't until just recently that you saw, more talk from, Ray Dalio, although Jeff Gundlach has been talking gold for a while, but a few other people. Morgan Stanley came out in the last month. I think one of their analysts said that we should tweak the 60-40 portfolio to be 60-20-20, where you split your bonds in half and you buy gold. But I doubt they've had any opportunity to make the switch. They've just started to recognize gold's value after denying it for decades. I've been in the investment business for, over 35 years, and I was pretty much a lone voice, as a stockbroker, telling my clients that they should have an allocation to gold in their portfolio. Yeah, when I went on major financial networks to talk about it, they generally laughed at me, or they accused me of fear-mongering or just trying to sell gold. They didn't accuse a stockbroker of recommending a stock because he's just trying to sell stocks. And of course, I was both, right? I was a stockbroker, but I also thought that people should have gold as part of their portfolios. But that was sacrilegious. But now people are starting to say, hey, wait a minute, given the fact that gold has outperformed stocks over the last 25 years, if you go back to 1999, when the Dow peaked at 45 ounces of gold, Today it's worth, well, it was 11. Didn't do the math today, but it was, just recently down to 11. That was a 70% decline in the price of the Dow Jones measured in real money, measured in gold. And given the fact that just holding gold, in a shoebox beat the Dow. And I'm not talking about just the price. It actually beat the return because the dividend yield has been pretty low over these years. You actually did better just holding a gold coin. And so I guess, given that, I think Wall Street finally recognizes that, yes, gold has a place in your portfolio. And if that's the case, well, this rally has a long way to go because that means a lot of investors have a lot of gold they need to buy. Meanwhile, the central banks are getting started. I don't think they're nearly complete in their transformation of their reserves. They still have a lot of dollars to get rid of and a lot of gold to buy. There's no way the U.S. government can repay that debt in money that isn't dramatically debased, meaning that the U.S. government will not be able to raise sufficient tax revenue to make good on its obligations. The Fed is going to have to print the money. And also, we have so much debt now that we can't even afford to pay a rate of interest that would be commensurate to the loss of purchasing power that you might experience holding U.S. debt to maturity. And, that's why Donald Trump is beating up the Fed to cut rates. In fact, that's why the Fed is cutting rates, even though inflation is well north of their, bogus 2% target and headed higher. They're cutting rates when they should be hiking rates. And it's mainly because we can't afford the rates that we have now, let alone the rates that would be required to restore inflation to 2%, right? So we're cutting rates, but we're letting our creditors know that if you hold dollar or treasuries, you're going to lose. We are going to debase what you're holding, and we're not going to pay you a rate of interest that's anywhere near close to compensating you for what you're going to lose to inflation. And so I think given that, the world has made a decision to get out of dollars and get out of treasuries. Why hold U.S. treasuries and earn a 3 or 4% yield if inflation in the U.S. is going to be higher than that? And of course, if the U.S. dollar is going to lose more than that in terms of purchasing power on an annual basis. And so rather than holding dollars and investing them in treasuries, they're going to hold gold. I mean, that's it. I mean, we've basically put them in that position. And I think what Donald Trump has done to really, sound the alarm and, give these guys, a kick in the ass as far as getting this done is, the Republicans and Trump, campaigned on fiscal responsibility, on, we've got to rein in the Biden deficits. We had all this inflation because of deficit spending under Biden and the Inflation Reduction Act. And so we need to get in there and we need to cut spending. And, they had Elon Musk, we're going to come in with Doge, the Department of Government Efficiency, and we're going to slash and burn. We're going to be like Milei in Argentina. We're going to take a chainsaw to government, right? So, these promises were made and none of them were kept. And when Trump not only signed on to the big, beautiful bill, but was one of the main reasons that it passed, he championed that bill, which not only preserved all the Biden deficit spending, but made it worse so that the deficits that Trump inherited from Biden, and, to say he inherited it, he also created a lot of it when he was president. But forgetting about that, the deficits that he, walked into when Biden gave him back the baton, now they're even worse. Now they're bigger than they were. On top of that, the credibility of the Fed, which in my mind, there was no independence. It was more of a pretense, but now they're dropping the pretense. It's pretty obvious that the Fed is political, and Donald Trump is trying to make it even more political by stacking it with, his cronies, the same way that Roosevelt stacked the Supreme Court to try to get his unconstitutional New Deal programs, approved by the court. Trump wants guys on the Fed, and he's going to have a chance to put somebody else in there to replace Powell because Trump wants interest rates slashed. He wants the Fed to crank up the presses. So again, this is a message that, look, if the Republicans are not going to be fiscally responsible, then nobody is going to be, because we're certainly not going to get that from the Democrats. They want to spend more money. Then I think on top of all that, Trump vilified all of our trading partners by accusing them of ripping us off and exploiting us and we're going to put all these tariffs on imports from your country. And I think he pissed off a lot of people and literally bit the hands that have been feeding us, because Trump really has it backwards. The world, we've been taking advantage of the world. We've been ripping them off because they give us real stuff and we just print money and hand it to them. And so our lives are better because we have consumer goods that we didn't produce, and all they get is paper. And what they've been doing with that is just loaning it right back to us. They buy our treasuries, they buy our mortgage-backed securities, they buy our stocks, and so they prop up our asset prices, they suppress our interest rates. So we've been living off of this, right? We've gotten low prices for consumer goods, lower interest rates on our home loans or our car loans. And, we've indulged ourselves at the expense of the rest of the world. We've lived above our means because the world has been content to live beneath its means to make that possible. Well, I think all that is coming to an end. And I think that's what $4,000 gold is telling you. And this is not, the end of this. Gold's going a lot higher, especially when the dollar really starts to tank. And I think you're going to see that, if not by the end of this year, sometime in 2026.
The rise of gold marks more than a market trend. It's the quiet confirmation that global trust in the U.S. financial system is fading fast. As central banks replace paper reserves with real metal, the dollar's privilege as the world's reserve currency is slipping away. The same system that once allowed America to borrow endlessly and consume without consequence is now turning against it. This is not just about inflation or interest rates, it's about credibility. Once confidence in U.S. debt is lost, recovery becomes impossible without sacrifice or revaluation. Gold is moving first, but the message is clear. The era of easy money and fiscal denial is ending. What comes next is a rebalancing that rewards tangible assets over promises. We're witnessing the early stages of a monetary reset that will define the next generation of global wealth. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.